This is Covered Calls with Kevin Simpson, featuring expert insights and analysis from the industry's top investment professionals. If you'd like a deeper understanding of today's markets, this is the show for you.
Thanks for tuning into this episode of At Covered Calls with Kevin Simpson. My guest today from Quadratic Capital is Nancy Davis. We're super lucky to have Nancy. She's the portfolio manager for Quadratic's interest rate, volatility, and inflation hedge. The ETF ticker for that is IVOL, which I love, and the Quadratic Deflation ETF, BNDD. She was named by Barron's as one of the top 100 women in finance, and we're super excited to have you today, Nancy. Thank you so much for joining us.
Thank you for having me on as your guest. It's great to be here with you.
Yeah, well, you're becoming a big star, so dropping down to our show and slumming it with us for a few minutes is great. We're lucky to have you.
Oh my gosh, no, I'm the one that's lucky. Thank you for having me on.
So I want to get right into it because over the weekend you sent out a tweet talking about where the Fed needs to go with interest rates. And this is your world. I mean, far be it for me to get into a conversation with you about fixed income or, God forbid, vol and fixed income. So I'm here to learn. But you said that the Fed needs to go another 187 basis points above the 150 they've given us so far. How do you see them getting us there?
So that's not, I'm glad that you asked that question because I probably should clarify it on Twitter. That's just what priced in. That's what the market is expecting the Fed to do. You can see that in, if you pull up Fed fund futures, that's looking at expectations for Fed hikes. So the Fed has been very successful with their commentary and their forward guidance because they've already removed the rates market. So right now I see 188.5 basis points of additional hikes priced in just for 2022. So if you think about it, we have, a little over 5 months left in the year, and the Fed has to hike 188.5 basis points. And that's in addition to the 150 basis points that they've actually hiked just to meet expectations. So forward guidance has really already moved the hike expectations. So it's sort of, in my opinion, like it's kind of like a potentially good fade because if the Fed doesn't hike 188 additional basis points, that's what's already priced in. And they could not hike because of, say, the economy getting weaker or more negative GDP prints or something bad happening or some catalyst we don't even know about. So the less Fed hike expectations is also one of the, IVOL has inflation in the name, but it does more than just that. It can also benefit from less Fed hikes, which is how we had positive performance in March 2020 when TIPS alone, which is about 85% of the portfolio at the time, was down because inflation is a risk on asset class, but IVOL tends to have, ability to make money when things are not going so great also, which is less Fed hikes or higher vol.
Talk to us about the other allocation within IVOL with the OTC futures and actually, I'll kind of leave the question open-ended and let you teach us because that's not something that financial advisors necessarily have access to, or certainly retail investors even more so, to get into that world. Can you just, in a layman's terms, educate us on the rest of the portfolio?
Yes, I think one thing that's super important for investors to keep in mind is any place that you have the ag index. It used to be the Lehman Ag, and then it was Barclays Ag. Now it's called the Bloomberg Ag. It's a really old index, and it has no inflation protected bonds in it because the Treasury didn't start the inflation protected bond markets until the late 90s in 1997. So the ag has no inflation protection in it. It's just regular treasuries. And then it's only short fixed income volatility. And this is really important to keep in mind because of its allocation to mortgages. So mortgages, very simply, you can think of it as a agency obligation coupled with series of short options. Because if you own the financial mortgage, like the ag, which is a third mortgages, you're actually short options to homeowners. And whenever you're short options, you're short vol. So I think there's a lot of focus on equity volatility. But I think the thing people really have to keep in mind is if you have mortgages any place in your portfolio, you are short fixed income volatility. And that's what we're trying to give investors, instead of just being short convexity and short vol and fixed income, a way to actually benefit from higher market volatility in fixed income, which is, it's, I would say, coming at when we launched iVol, obviously we didn't know that there was going to be, so much inflation, or having the quantitative tightening starting June 1 is a pretty good, I think, catalyst, especially because the Fed has been very transparent that they don't want to own mortgages on their balance sheet long term. So it's not, I know it sounds like a mouthful and very foreign to a lot of people, but I think it's important to keep in mind that mortgages are short fixed income volatility. It's sometimes called prepayment risk or negative convexity. And those are just jargon terms for saying owners of financial mortgages are short options to homeowners.
So you've been doing this for a really long time, even when you were at Goldman as prop trader for hedge funds. Is this the best market for volatility?
I think it's hard to know, obviously, what's going to happen in the future, but I would say the divide between realized inflation at 40-year highs and future inflation expectations, not anywhere near realized, is a very wide gap. So the market has become, I would say, potentially a little complacent that the Fed hiking rates is going to slow inflation. And I feel like the Fed hiking rates is definitely going to impact the demand side, right? The demand side of the equation, but it doesn't necessarily fix the supply side of the equation, which a lot of that is, whether it's a global chip crisis or the labor market shortages or supply chain disruptions or geopolitical risks, all those things still remain. So I think it's a important time for investors just to be aware of what their bond portfolios actually have exposure to. And most funds that are core fixed income don't have inflation protection in the bond portfolio. And they also don't, they're only short fixed income vol through the mortgages. So it's just an important time to kind of rethink things and not be blind to the 60-40 portfolio, because I think 2022 has been a real wake-up call that stocks and bonds can lose money together, and that potential correlation, might not be as diversifying as it has been.
Well, you just had a great article in Bloomberg that really highlighted that 60-40 challenge for financial advisors. Any thoughts on what they could be doing right now to position portfolios with that kind of risk budget in mind, thinking like, of course, 60-40 worked in 32 years of deflation and 32 years of decreasing interest rates. Like, it was a pretty easy set it and forget it idea. That, as we've learned this year, might not be the case moving forward. So any easy, maybe not even easy, but just any advice for financial advisors in terms of repositioning?
So we do think iVol is a nice way to complete that 40% of the portfolio and give it inflation protection, future inflation expectations, and also neutralize the short vol. So I think a lot of financial advisors are using it as, I would say, it's sometimes called a completion portfolio, where they have an allocation to the ag or to core fixed income, and then they want to add in inflation expectations in the future outside of CPI, and also give something that potentially could be non-correlated to, very simply equities and credit, which is, the equities corporate, it's just a different part of the capital structure, right? If you own, I don't know, XYZ company's stock, and you also have XYZ company's bonds, and that company has higher labor costs or less revenue or higher expenses, typically credit spreads widen with equities. And so having a little diversification, I feel like the people who love iVol more and who have it as a bigger weight are the ones who are just like, we don't want any more credit in our portfolio. We'd rather have equities to have that corporate beta risk and have more upside potential, but have something there to potentially diversify the equities in a different way.
I can see that for sure. I'm more, I know iVol gets most of the attention when we see you on TV. But I think that BNDD is more interesting to me, just from the standpoint of positioning for a pullback in inflation, because maybe the supply chains start to get a little bit better. Maybe the Fed does have some impact, whether they're the major catalyst or not. But if we do get into a deflationary picture, and you're thinking about maybe a contrarian thesis right now, I'm more intrigued by that fund at the moment. And I'm curious to see what your thoughts are. Obviously, you run them both, and it's like two kids, you love them both. But what are your thoughts on kind of my thesis there of introducing BNDD into a portfolio as well?
So we do have both strategies. It's sort of for investors to express their own viewpoints. And, I feel like these are like Lego blocks, and you can build whatever dream castle you want with them, so to speak. But personally, I think eyeball is something that is important, whether it's eyeball or something else, but to have, I think, we live in a real world, and investors generally are looking at the 70s for the last period of inflation. But the problem is, in the 70s, think about the Treasury didn't even invent the inflation protected bond market until 1997. So there were no, the interest rate derivative markets didn't exist. The TIPS market didn't exist. So a lot of people are looking to commodities or equities or real estate for inflation, because that was the only thing that was really available in the 70s. I personally think, especially as you get closer to retirement, you tend to have more fixed income in your portfolio, and therefore even more exposure to inflation and inflation expectations in the future. I think it's also super important for people, financial advisors whose clients are retired. Like, if you think about, a personal balance sheet, if you're not in the labor market and there's inflation, you're not going to benefit from the wage inflation on your personal balance sheet. So I personally think inflation protection is just something that investors should have as part of a diversified fixed income portfolio, because if you're going to own fixed income, you kind of have that exposure to interest rates already. And also, I think a lot of investors have the bulk of their net worth in real estate. Most real estate investors will try to hedge their rate exposure, because as we have the Fed more aggressive with hikes, and as mortgage rates go higher, you kind of need wage inflation to be able to afford the same monthly payment, because the mortgage market is, the real estate market is very dependent on leverage, which is mortgages. And so to me, I think, inflation protection, something like eyeball, is pretty important to just have as part of a diversified portfolio, and not really taking a bet, especially like, say your life expectancy is, 10 years, 20 years, 30 years. You're more at risk that we have inflation, and you have less purchasing power, especially if you're not in the labor market. But I know that's a really kind of different way to think about things. I know a lot of people are trying to say, oh, we think inflation is going to fall, or we think it's going to rise. And in my eyes, I feel like everybody is already short it. So if you don't have it in your portfolio, you're shorted in your real life. So.
You're spot on. And we live in opposite ends of the investment spectrum, but we service the same client. It's that person who's retiring and will be hopefully in retirement for longer than they were in their working careers, healthy, spending money, but faced with that realization that inflation isn't going away. It might be short-term reducing a little bit, but over the longer term, the prices of college and maybe gasoline right now is at an all-time high, but looking at things to think that we're going to go through a period where inflation just stops is not realistic. So servicing that fixed income retired investor, the baby boomer market, you're talking about inflation hedging within a fixed income portfolio, introducing tips. There's always the comparison to the 70s, people sort of forget about what's happening with the employment market right now, but we use rising dividend stocks for that same case study that you're talking about, which is presumably we're going to be in retirement for a long, healthy period, and we're going to need to have more money down the road than we do today. So the textbook, like you said, raw land, real estate, commodities, I mean, that worked in the 70s, maybe even energy, I guess, to a certain extent. But to me, it's about rising dividends. Give me a raise every year, because I know what that means.
Yeah.
So pair Devo with eyeball, we've got a good, pretty good mix there.
Yeah, I think it's just really important to to really think about what the future is going to look like. And I think it's also, it surprises many investors that realized inflation is so high, but future inflation expectations are so much lower than where realized is. Like, the problem with tips by themselves is the only measure of inflation is the consumer price index, right? It's one index. It would be like nobody would own the Dow Jones index and say, ta-da, I have US equities. Why does everybody do that with inflation and inflation expectations? But the tips market is very downward sloping. So like the last inflation print was 8.6 in realized terms, but the 10-year break even, which is the measure of CPI inflation, is 2.62 right now. So 2.6, it's under 275. So it's much lower than where realized inflation is. And then what we do with iVol is we try to take that core tips portfolio and give another measure of inflation outside of the CPI index, because the problem, the CPI index, a third of it is what they call shelter, and shelter is actually owner occupied rent. So it's just not it's not what the Fed uses. Actually, they tend to look at PCE and other indices, but it's just not the only way to measure inflation. I think the best comparison is using equity indices. There are actually more ETFs than stocks, right? There's so many ETFs, and measuring corporate America, nobody would ever measure the stock market with one index. Why would you do that with something as big and harder to measure like inflation?
Well, that's why you get so, or at least I do, you get so frustrated with the core CPI because it's nothing. And now you're taking food and energy out, it's basically just rent. And I know there's other things in it, and I hear the arguments, but it's I guess that's probably why the Fed likes the PCE better.
Yeah, no, it's hard to say. It's hard to measure something like that, but that's why we think interest rates are such a simple way of looking at inflation expectations in the future. And the rates market is saying, look, we believe the Fed is going to hike. Those hikes are already priced in an additional 189 basis points just in 2022, in addition to the 150 have actually realized. But right now you actually get paid less yield to own a longer dated bond. It's actually like a tax to own longer duration bonds, because I think a lot of people are saying, the Fed hiking is going to put the economy into potentially a recession. So it's all about what's priced into the market. And right now the market is saying, the Fed's hiking, and that's going to be very bad for growth and for the rates market has already priced it. It's actually, the yield curve is fully inverted in the forward space, which includes the Fed hikes.
So does that mean we're going to be in a recession in the next 12 to 18 months, as so often happens with an inverted yield curve?
It's hard to know whether it's the chicken or the egg, like which causes, there's been a lot of studies looking at it, but I think very simply, if you think about what it is, the Fed sets a policy rate, but the term structure of rates is the yield curve, right? It's where lenders lend money. And right now, when you have an inverted curve, that means I lend, you, Kevin, money for 10 years and I get paid less than if I was going to give you a loan for 2 years, right? That's not an economically rational thing to do. You're basically saying I get less value, it's priced for actually a disinflationary environment. So it's hard to know whether the yield curve causes a recession, the inverted curve, because then credit is stopped, right? Like, why would I lend you money for 10 years and get paid less?
Right.
So it's hard to know whether it's chicken or egg. Does the inverted yield curve cause a recession, or is it a crystal ball saying that the recession is coming? I think the reality is many investors think we're in a recession right now. So it's all what's priced into the future. And right now the rates market is saying, even though realized inflation is very high, future inflation expectations are going to be significantly lower. And I think that's really where the opportunity exists for investors, because you always, in all markets, right, you want to buy low, you want to sell high. And I think most investors don't have inflation in their portfolio, and they have it in their real life. And it's a good time, I think, to be thinking about helping to diversify, whether it's, dividends or interest rates, just other things outside of that traditional 60-40.
I totally agree. And I'm in that camp that we're in a recession. And I know the economists will argue and say that it's not the case because of where we are with the employment sector, but I tend to think that might be peaking as well. But from an eyeball test, this is a recession. You look at the gas prices and the prices at the supermarkets. And in the old days, it was just, 2 quarters of a decelerating GDP. Now I know that it's not the case anymore, and that the National Bureau of Economic Research has a whole lengthy list of things that will define a recession. They'll tell us later. But I feel like, from a practical standpoint, from a layperson standpoint, it sure smells, looks, and tastes like it in a whole lot of ways.
Yeah, no, it's definitely, you can call it what you want, but a lot of people have lost a lot of money.
Yeah.
It's been a really tough start for 2022. And it just seems like, to me, I don't really see how the Fed hikes are going to alleviate the supply side disruptions, because so much of them are unrelated to, they're related to other things that are happening in the global markets. So
that makes their job even that much more challenging, because the control is gone, and so many of the levers have will have little impact over the supply chain, to your point. So I totally agree. The last topic I want to touch on real quickly is something that I'm always interested about, and I know financial advisors are, especially their clients. Where do you rank municipal bonds right now as far as an investment? Is it something that people should be considering now that rates have come back? For the past few years, no one wanted to look at fixed income, even for munis, because of where interest rates were. But now that there appears to be a pulse in the yield market again, is it time to look at munis?
It's I'm not a muni expert. I would say I think a lot of people are depending on their tax profile, use munis. It doesn't necessarily, I think you want to have a diversified portfolio. I know some investors look at IVOL. If you go to our fact sheet and look at the second page, we have kind of a different tax treatment for the options. They're actually taxed as ordinary assets, which it's very different. It's more, potentially something that people have been saying, look, if we want munis because we are looking for tax efficiency, ETFs provide a lot of tax efficiency, and also having that ordinary treatment from a tax point of view on the options is pretty different, because if the, say a bear case scenario, if the options don't work, and say super bear case scenario, they expire worthless, they can actually generate negative ordinary income for the fund, which is, I think when you look at munis, a lot of people own them because of the tax benefits. So there are a lot of different ways to look at investing. And I think it's important just to have a lot of diversification, and you don't want to have, especially some of these states have a lot of businesses leaving. So it really depends on where your exposure is.
I think that was a great pivot to IVOL, especially when you think about the options within the wrapper of an ETF. We do a lot of covered calls in Devo, and I'm always fascinated by the tax treatments of exchange traded funds. So another really good reason to look at IVOL. Nancy, I could sit here and talk to you all day, because I've learned more listening to you over the past months just on television and here. And I think everyone is grateful for your insight and for introducing us to something that isn't accessible everywhere else. I mean, to be a thought leader is one thing, but to have access and allow us to invest with you is awesome. And so thrilled to have you here today.
Thank you so much. You're so kind. I really enjoyed being your guest and having this discussion. Thank you very much.
Thanks, Nancy.
This message does not constitute an offer to sell or a solicitation of an offer to purchase securities through CWP Advisory Services. Investments are not guaranteed and involves risk of loss. The views and opinions expressed in this message are those of investment professionals made at the time this content was recorded, are not necessarily the views and opinions of CWP, and may change in time without notification. For additional information about CWP, visit CWP's or the SEC's website for a copy of our ADV disclosure brochure and Form CRS.